No, bad debt isn't an outflow. What was the outflow in terms of cash flow? Correct, good. Okay, so before selling those goods, you would have had to have purchased those goods. Alright, so when you're talking about the outflow or the impact in terms of finance, okay, you're correct looking at the debtors and the bad debts, okay, the credit losses, right? But the credit loss itself isn't a cash flow, right? You wouldn't include this in a cash flow analysis, okay? Your debtors would be seen as being affected because you would have decreased your debtors. This would have been part of your net working capital. Okay, so net working capital is being affected by creating the debtors. Okay, not receiving the cash flow creates even a bigger problem because now I finance stock to sell to someone on credit, but now no one's paying for that particular item that they've bought. Okay, good. And then the last one, when operating a business, are costs constant? What is the consensus? No? Did you agree with that or disagree?
Cost isn't any cost.
In general, yeah. When operating, are costs constant? Okay, definitely not. What can change those costs? Okay, so operations. So for example, if I'm looking at manufacturing a finished product, okay, what costs would be included in the finished product which would be seen as being variable, not constant? Production costs, so maybe the wastage, okay, that could be something that could be maybe more or less depending on how well that particular process is managed. Okay, so you might have more wastage or less wastage. Okay, something else that isn't constant, that's external, is inflation, right? What happens if the cost of your goods had to rise because of inflation? Okay, maybe a weakening rand, okay, or rising interest rates. Okay, depending on what sort of situation we've got, prices can be affected in the markets. Right, then you've got two notes over here. What is a spontaneous liability? And what factors drive unexpected or spontaneous liabilities? Right, so let's first start off with the word spontaneous liability. Okay, we spoke about the definition for spontaneous. So how would you describe a liability that is spontaneous? What type of liability are we dealing with here? What is it? Yes, okay, unexpected, not planned for, that would be something that you would use to describe it. Good. Okay, so an unexpected liability arising from the normal course of business. Okay, trade and other payables and accruals could be two that you could consider as being spontaneous liabilities. Okay, what is an accrual? You've looked at it in accounts. When we look at an accrual is a journal entry for what? Possibly? Yes. Okay, so yeah, that's taking a bit more, taking a lot further in terms of knowledge, okay, in terms of your accounting. Right, but if I'm looking at accrual, an accrual is what? A provision for something that will happen in the future. Okay, so accrued expenses. Is that a liability? Yes, accrued expenses. Okay, so what is an accrued expense? It's an expense that you've incurred that you haven't paid. So you create an outstanding liability. You provision for a liability. But if you're providing for a liability, is that something that's going to be classified as part of your net working capital? Is a current liability part of your net working capital? Okay, well, the accrual would be an accrued expense. And what is an accrued expense? That you've incurred, that you haven't paid for. So is that part of operations? Is that part of short term? Yes, so not all provisions. Yeah, accruals wouldn't be part of your cash flow. Okay, but would accruals be considered part of your net working capital? Yeah, because if you haven't paid for an expense and you are required to pay for it, it is a liability. It is an obligation. Okay, it's not something you've created. So if you create a provision, That's a made-up liability. That's a made-up adjustment. Okay, based on your expectation for what's going to happen in the future. Right, so you think debtors aren't going to pay you. You think creditors aren't going to pay. Okay, in terms of creating an allowance for the two. Okay, allowance for maybe a settlement discount or a provision for settlement discount. Okay, so what factors drive these unexpected liabilities? Okay, generally external. So give me a factor, an external factor. Okay, the rate could obviously affect certain liabilities, sure. What else? Would time have an impact? Would that be a factor on this unexpected spontaneous liability? Yes, it would. Okay, so the accrual, right, would obviously have an element of time. Okay, the timing would create a spontaneous liability potentially. Demand, in what sense? Like how? Oh, okay. So you're looking at like, okay, yeah. So seasonality, yeah. In terms of, so maybe you might have a unexpected spontaneous liability occurring based on the changing demand in a particular month. Yeah, perhaps. Okay. Right. So how do we manage or deal with these spontaneous liabilities? These unexpected liabilities. What do we do to help manage them? Yeah, you have contingency plans in place, and what would the contingency plan be? Correct. Having access to funds to supplement the change in need in terms of financing. Okay, so obviously we're going to need a backup. Okay, so companies need to have some sort of short-term financing in place that's going to provide or provision for any of these spontaneous liabilities. Okay, something that we're not expecting. Okay, so unexpected costs need support from short-term lines of credit. Okay, so that's what we're looking at. Okay, so you get two types. You get unsecured and you get secured. What's the difference? Here's the difference. Which is this one? Why is that secured? Correct. And why is this unsecured? No collateral. Okay, so the key is security in the form of collateral. Okay, I didn't write the word down. Let's write it down. Collateral. Okay, collateral meaning the security or the asset committed to that particular loan, okay, or liability. Right, so if I take out a loan or a bond on a house, there is collateral. Okay, so from the bank's point of view, is that risky lending? No. Okay, because in a worst case scenario, the bank's going to get back the property that they financed. Okay, in a best case scenario, they're going to get a lot more interest. Okay, so in terms of loans, liabilities, you get secured and you get unsecured. Okay, in a credit card sense, right, what is the risk for the bank or the financial provider? Financial institution, in terms of unsecured, they get nothing. Alright, there's no benefit that can be received back in the future. At least with a home loan, I can receive something back in the future. We can receive the property back, it becomes ours, we can auction it off, and that should cover the liability. Right, so the risks are a lot lower when it comes to a lending point of view. Okay. Right, and most important is to remember, without cash, companies can't operate. Okay, so firms want cash, as much of it as possible, because that creates, or let's say facilitates, the cash conversion cycle. Okay, so having cash in the business allows us to operate. Having more cash in the business allows us to better operate, okay, or to operate more effectively, okay, to really, really maximize, let's say, output, okay, and generate more wealth and value for shareholders. Right, so firms want access to cash without unnecessary costs. Okay, no one wants an unexpected cost. Okay, something unexpected, something that we weren't expecting in terms of being spontaneous. Right, so how do we deal with certain things like that? Okay, there could be interest-free periods, there could be credit terms that we could consider to help us with this whole access to cash story. Okay, we need to try and make it easier to pay for all the liabilities and to cover all the liabilities without too much of a burden on the company. The company doesn't want to always go and seek capital every time there's a problem in the business. Okay, a little bit of revision. We spoke about this earlier. Okay, so what is the major source of unsecured financing? Creditors. Okay, why is creditors considered the most popular? Okay, it's easy to acquire as well. Why? It depends on your relationship with the supplier. Right, so in what sort of market would you say it would be easier to negotiate better credit terms with that supplier? Would it be easier to negotiate better credit terms in a recession or in a boom? Why in a recession? Exactly. Okay, so if I'm looking at a supplier, remember, what do suppliers do? They finance the purchase of inventory. Okay, so those two are linked. Right, it's the creditor who's normally the provider of inventory. Okay, so in a recessionary type of environment, the creditor is going to have less bargaining power to offer credit terms, okay, than in a better position. Right, in a boom, they've got choice in terms of which consumers they're going to be choosing as customers. But in a recession, you might not have a choice in terms of choosing your customers or your clients. Okay, so a creditor wouldn't want a recession. A creditor would want a boom, okay, a better working environment. Okay, obviously from a financing point of view, we would be able to secure better terms in a more difficult environment. Okay, because they're seeking more and more debtors, okay, to take out credits. Right, so why? What does that do to the business? Why? Why is trade and other payables such an important source of credit? Okay, it affects the cash conversion cycle positively or negatively? Positively when what happens? When you extend the payment, when you lengthen the APP. Okay, so it directly affects your CCC. Right, creditors is a direct effect. Okay, it's a factor that's direct in terms of affecting your CCC. Okay, so long as you're negotiating or renegotiating or creating better credit terms, you'd be directly affecting your cash conversion cycle. Right, it's almost like an immediate benefit. Okay, think about it. If you've got 30 days as a current, let's say, term linked to your facility in terms of credit. So your creditor will allow you 30 days to pay. Let's say you can negotiate and double the period from 30 to 60 days. How is that going to help your business? So you've lengthened it by 2. So you probably would have potentially reduced your cash conversion cycle by maybe a half even, perhaps. Okay, so depending on your AAI, your ACP, okay, you could have drastically changed your cash conversion cycle, right, just by increasing the term on your particular facility with your creditor. Right, so APP is the last component. So what is the view on APP? What's the view? What's the view on APP? How are we going to view APP? APP is what? Average payment period. So if we have a view on APP, what's the view going to be? Yes. Okay, if we can delay payment later on, that'll be better for the business. Okay, so creditors, we know, is the actual trade and other payables. Pay as slowly as possible. Okay, that's our view. Our view as a business operating would be delay or extend or pay as slowly as possible without incurring additional costs. Okay, that's probably the most important. You don't want to have a 60-day payment period, but if you don't pay after 30 days, you get a massive interest charge to your account. That wouldn't be feasible. Okay, it wouldn't make any sense using the 60-day then, if you're going to be charged more interest on that account. Okay, so analysis. How do we analyze credit terms then? Time horizon. Are longer credit terms better or worse? Better. Okay, good. All right, so time is part of our time value of money in terms of a concept N. Okay, so obviously we know that the longer the term, okay, so if I have a longer term, okay, if you're looking at discounting, if you've got a longer term, your PV would come out as negative. Okay, here we're looking at what? When do I actually pay the outstanding amount? So do you agree, if I'm looking at time value of money, where am I currently focusing on? Well, I'm looking at this, time 0. Let's say you had to pay immediately. Okay, where would that be? At time 0. So if you had to pay 10 at time 0, that'll be today. Okay, without credit terms. If you do have credit terms, do I want longer or shorter terms? I want longer. Okay, so let's say I've got credit terms of 30 days. Okay, T30. Right, this was the present value because you would have had to have paid there, but now you're going to pay here. So what do? You take it forward. If I take amounts forward, what happens to them? They get bigger. Okay, so here we're looking at now we need to make payment, but we can postpone or delay it. Does it make sense? Okay, so I'm not looking at the discounting. So your theory was correct in terms of discounting. The longer the period, the smaller the PV. Okay, but we're looking at the PV and we're saying, well, today I'm required to pay X. If I can pay that in 30 days, obviously time value of money, if I take 10 to 30 days, the amount should get bigger. If I take that to 60 days, it should even get bigger. Alright, so the value that you're creating in terms of taking the payment forward becomes more and more of a benefit to your business. Does that make sense? Okay, so that's the key. The key is to lengthen or delay your credit as much as possible because you get a bigger and bigger benefit the further forward you can push that payment. Okay, then that's something we need to look at in terms of the cost of the discount or the cash discount. Okay, so if I forgo the discount, what's the actual rate, okay, of having foregone the discount? So that was the CD equation. Remember that one? Did we look at that last week? I think we did. CD, cash, the cost of giving up a discount. Did we or didn't we? We didn't. Okay, so we'll look at it today. Okay, then we'll look at it today. Okay. Alright, so you probably went over it yourself when finishing off this module. Probably. Okay, but we'll look at it here. Possibly, maybe. Yeah, you mentioned you're doing the assignment and you did some extra work as well. Okay, great. Okay, so what view would the business have on the following in their books? Debtors. What is it? In their books. So what are we focusing on? Accounting. Okay, so what is a debtor? An asset. What is a creditor? A liability. Okay, if I look at it from a financial management point of view, okay, finance, so inflow and outflow, debtors and creditors. Debtors would be seen as what to the business? Inflow, outflow. Increase or decrease in net working capital. Okay, decrease in net working capital. Okay, so this would be seen as a outflow in terms of having to finance it. Okay, that's the financing. I'm financing my debtors. Every time someone buys on me, right, that's creating an outflow, inverted commas, because you are going to have to be buying stock to give them. Okay, you're financing their purchase rather than your business in terms of operations. Okay, creditors would be seen, inverted commas, as an inflow, a way to finance your business. Okay, so there's a difference, obviously. Accountants want more assets than liabilities. Financial managers want more cash flow than accruals, yeah. Okay, so debtors and creditors are accruals. Okay, so here's the note. Okay, so after having covered these slides, we'll know what the cash discount is in terms of its effect on the business. Okay, so which credit terms are more favorable for the business? Let's talk generally. Okay, so, okay, Tanya, you can answer the first one for us. Okay, so you give us your thoughts on A and B. Which do you like better? And then Indira, you can do C and D for us. Okay, so look at those two companies and think about as many points as you can possibly think of that would either go for or against one of the different credit policies. Okay, so do we like A more than B, or do we like B more than A? Yeah? 3 over 15 is a 3% discount within 15 days, and the net must be paid within 45. Okay, so 3 over 15 is the percentage that you're receiving, okay, as a discount on early settlement. Yes, so if paid within 15 days, a 3% discount would apply. Okay. Alright, so quickly try to think of as many points as you can. Look at the amounts, look at the terms, look at the periods. You decide, okay, from a finance point of view, which would you prefer, A or B or C or D? Yeah, we don't need to calculate anything. It's just a discussion point for now. Okay, so don't take it too far in terms of being or trying to work out amounts. It's not necessary for this particular example. Okay, do you guys have some points? Alright, let's start with the first one, A or B. So, Tanya, evaluate those two possible credit providers, A and B.
Basically, between 60 to 45 days is 15 days. So I like the 60 days because the discount is 15 days.
Yeah, okay, so in example one, all right, company B is currently offering more superior credit terms than company A. Why? You've got a longer period to pay off the balance, okay, versus company A. Right, so in that particular situation, we would definitely go with B rather than A. Right, Indira, what did you say for C and D?
So amounts are obviously different.
Yes.
So company C gets better credit.
Okay, so company C is offering a better facility, sure?
Yeah. And then, but company D is a longer period.
Okay, but they're giving a smaller discount as well. Alright, so is there a definite answer here for C and D? Did you say which one is better?
I said, for some reason I said D because if you look at the interest and the day in which you get the discount made,
Okay.
it's practically the same.
How would you say practically the same?
Because if I'll take 15 divided by 3, it's 5.
Okay, so you're trying to work out things which you don't need to.
Yeah.
Okay, but let's hear the logic. Okay, so 15 divided by 3?
Is 5, and then 10 divided by 2 is 5. So practically the interest, well, yeah, the discount is the same. But I would rather go for D because even though company C is giving high credits, I can pay 15,000 in a
Longer term. Yeah, so see, that's the debate. Okay, but that's good. That's a valid point. Okay, so part D, so we like D better because of this. The term. Okay, I've got longer to pay off the liability, but I've got a smaller facility. Okay, you could go with that as being the benefit, okay, for the business, but you could also go with this. 20,000 is a bigger facility. So are you comfortable with a smaller facility with longer terms, or are you comfortable with a bigger facility with shorter terms? Okay, it all depends on the type of business. You could maybe say, well, C is actually better because C is offering you more credit. And if I can get my hands on more credit, you've got more opportunity to do more with that particular financing, even though it's still shorter in terms of term. Okay, so both have their pros and cons for each of them. So C and D, it's a debate. It's a toss-up between the two. Okay, there are pros and cons for both. But obviously, from a working point of view, you can work out an actual cost of giving up the discount by looking at that. Okay, that's what we're trying to look at here. Okay, so there's no definite answer there. C and D, it all depends. You need to motivate. Do I want a bigger credit term, or facility rather, or do I want a longer credit term? Okay. Alright, so this point over here is looking at the credit terms. How do we analyze it? Okay, so it was easy to differentiate between A and B. It was more difficult to differentiate between C and D. Okay, so when looking at the cost of giving up a discount, that's the formula. CD over 1 minus CD times 365 over N. Okay, that gives me the cost of giving up a discount. Okay, so if I have a look at this example, calculate the cost of giving up a discount for credit terms 2, 10, net 30. So what does that mean? I get a 2% discount within 10 days, and the remaining must be paid within 30. Right, so what would the formula look like? Well, let's substitute into the equation. Okay, what is the discount? 2%, so 0,02. 0,02. Okay, what are the days foregone? So if I don't give up the discount, how many days do I forego? 30 minus 10. Okay, the number of days foregone. Okay, because if I utilize the discount, I don't need to pay off the liability, right? Okay, so 30 minus 10 would give you 20. And if you type that into your calculator, what do you guys get? Not points? 405, no? What did she get, Zero? Try again. You might have to use brackets here. Okay, 1 minus the discount. So you might have to put a bracket in the denominator for the 1 minus. Okay, yeah. Do we all get that? The cash discount is 2%. Okay, so 0,02. So you'd have 0,02 here. You'd have 0,02 here. And in the end, you'd have 30 minus 10. Number of days foregone. Yes, percent. The cost of giving up the discount is 37%. 37%. It's a measure of the cost.
Oh, so I can't put that into rand.
No. No, you can't. It's just a measure of cost.
So then you have to have something where you have to also say.
So this is a very big discount to not utilize, if that makes sense. Okay, the cost of giving up the cash discount is great. Okay, did you get it? Okay, good. So you all got that figure, hey? 37,24489. Great. Okay, so see if you guys can work out the next few. I've given a few more examples here. 34234. Quickly work those out. Okay, and then we're going to use this slide as a comparison. Then you're going to tell me which of these terms are better. Do we have all three? Did you get all three? You got them. Okay, so Tanya, what did you get for 2? Okay, 8.1. Okay, 8.1. Did you get 8.1, Indira? Okay. Alright, so what was your CD here, Tanya? 1%. So it's 0.01 over 1 minus 0.01 times 365 over what? No. No, we look at this one. 2.
Oh, sorry, I'm waiting for example 3.
Okay, so what is 3? 12.
12.8.
No.
No, that's something else.
Yeah.
Okay, that's what I wasn't sure.
Okay. Okay, so
This one I got 8.1, that's right.
okay, so yeah, 2 was the 55 minus the 10, which is the 45. Okay. Alright, Indira, 3? Yeah, that's correct. Okay, so 22.57 will be the cost of giving out the discount for example 3. Right, and then 4, Tanya? Yeah, that one's right. Okay, that one's correct. Okay, so looking at that, which is better? Which credit term is the best? Okay, so which credit term would we choose? If you wanted to take the discount, you would go for example 4. Why? That's the cost of not taking the discount, right? The cost of the cash discount. Okay, so the cost of the cash discount is 37.24. That's the cost of the cash discount. Yeah, that would be the smallest terms in terms of cost of giving up the discount. Yeah. Okay, so it's theoretical, so maybe just to highlight the definition for the cost discount. Okay, you'll see that here in the textbook. You pull that up. Okay, so if I look at the cost of giving up the discount, okay, just to show that to you, so credit, cost of the discount. Cost of giving up a cash discount, 624 in the new textbook. Okay, so if you look at the definition, right, they talk about cash of giving up a cash discount, the implied rate, okay, of interest paid to delayed payment of an account payable for an additional number of days. Alright, so what is that referring to? It's referring to like an IRR type of situation. So what is the implicit cost associated with giving up the cash discount? Okay, it's an implied rate of interest paid to delay payment of an account payable for an additional number of days. Okay, because do you agree, if I use the cash discount, do I owe the outstanding liability? No. Okay, remember you can only use the discount once, if that makes sense. Does that make sense? You can't use the 10 days and the 55 days. Does that make sense? Okay, so if I'm looking at this, let's interpret this correctly. Okay, so what does that mean? The 110 net 50. What does that mean? Let's interpret it. The 1 net 55 means what? Can I use the 10 and the 55? No. Okay, you need to choose. Okay, that's what you said was important in terms of, are you going to use the discount or aren't you? Okay, when do you get the 55 days in terms of financing? When you don't use the discount. Okay, and if you do use the discount, when must you pay? Within 10 days. Does that make sense? Okay, so we're looking at, if you pay within 10 days, you're doing what? You've paid the outstanding liability, so you don't have a liability to pay for. If you don't pay within 10 days, then how much financing do you have? 45 days. Well, 55 in total. Okay, but 45 days after having not used the discount. So you've extended the term by how many days? 45. Okay, so you're weighing off the pros and the cons. Do I pay everything now, okay, within 10 days and receive a 1% discount? Or do I forego that 1% in order to extend my financing for an additional 45 days? That's what you're looking at doing. Okay, is that worth it? Is the cost of giving up the discount worth extending the credit, if that makes sense? Does that make sense? Okay, so that's what you're actually looking at here. It's the implied rate. Okay, it's theoretical. All right, you can't do both. It's one or the other. You either pay it all off or you extend it net 55. Okay, is that all right? Okay, Alright, so stretching the trade and other payables is key. Okay, there's a missing word here, payables. Trade and other payables is key. What is the goal of the firm? Maximize shareholder value, correct. So are there any consequences for not paying? Of course there is. And what are those consequences? Interest, penalties, right? Additional costs. Okay, so most important that we need to consider is the credit monitoring. So do we need to monitor our debtors? Yes. How do we monitor our debtors? We use an age analysis. How do I monitor my creditors? Well, you could also use an age analysis, but you'd be looking at the terms. Okay, you'd be looking at the costs. Okay, so if I don't pay, how much is that going to incur in terms of costs? Alright, so do you agree credit terms are actually very, very, very important from a negotiation point of view? Why? One supplier could get more business purely because their terms are a lot better than another supplier offering the same product but different terms. Okay, so if you're trying to compete with your competitor for a consumer, you'd also be looking at credit terms. Okay, you'd be trying to generate credit terms which meet their requirement and which also help you in terms of your business. Okay, then a note here about an accrual. What is an accrual? We spoke about it a bit earlier. How would you define an accrual? A journal entry for a provision or? A timing difference, right? Okay, so liabilities for services received but not paid. There's a timing difference. Okay, so you always have timing differences with things like a liability, with things like even an asset. There could also be a timing difference in terms of depreciation. Okay, right, so can accruals help companies manage cash flow? Yes or no? Of course it can. Okay, it's a form of short-term financing. The more accruals you have, the better, in inverted commas, because it helps provide cash flow, okay, for the business. Right, so what is the most common company accrual? Besides creditors, that's an accrual in a way, but it doesn't meet the real, let's say, definition of an accrual being a service that has been received but not yet paid for. So what do companies use often that is services that they've received as a company but they haven't paid for yet? Can you think of it? Good receivers? No? Which one? What is it? Think about it. What does a company use often? And they never pay for it. They only pay for it at the end. All companies do it. Small, big, doesn't matter what size. The most common company accrual is what? No. Not all companies will have depreciation. But all companies will have wages. Why is wages an accrual? It is. You pay it at the end of the month. So what happens during the month? Workers are working. Yeah, do workers get paid after each day? No. Some workers maybe, perhaps. Okay, more casual staff. Right, but in general, wages would be the company's most important accrual. Why? Companies need people to operate. So the business operates for a full month. And only at the end of the month does the company actually pay the wages. Okay. It is a timing difference because you're working today but you're getting paid later.
I don't know, I think I'm just purely looking at it from an accounting sense.
Yes, okay, if you're just looking at accounting, here we're looking at the cash flow. Yeah. Right, so do you agree, if you could pay your employees every year, would you take that option? As a company, of course you would. Why? Because you would delay paying any wages for an entire year. Okay. You probably wouldn't have happy employees. All right. But let's say if your employer said, we won't pay you monthly. We'll pay you once a year, but we'll give you all the investment income we derive on your salary over the year as well. Hey? See, that's a different story. Because now you're looking at, well, if the employee can't manage their funds, why not let the company manage it for them? Okay, but again, it's an accrual. Okay, because now you'll be working for 12 months with no benefit until month number 12. Alright, and that could be a problem. Okay, that's the end of that chapter, guys. Alright, we've got one more to look at today, which is the last theory chapter.